The aim of active investing is to beat the market, but in the long run, only a tiny proportion of investors do. Have you beaten it? There are broadly two types of investing, active and passive. Active investors try to outperform through stock selection and market timing. Passive investors, on the other hand, simply want to capture the market return. Generally, the investing industry wants you to invest actively. It usually makes more money that way. But the percentage of investors, including professionals, who genuinely outperform the market in the long term is very small. For Mark Hebner, this was a very expensive lesson. At the age of 32, Mark sold his pharmaceuticals business for a large sum. He was then cold called by a broker who'd heard about his windfall, and Mark decided to become a client.
Over many, many years, 12, 13 years, he kind of bought this and sold that, and I really didn't pay much attention to what was going on, and literally had no knowledge of the proper way to invest. At least 3 or 4 times a week, we would be on the phone, and the conversation would be first, do you want to buy some oil stocks today, or maybe we should buy some gold, we should do this or do that. And I said, oh, okay, yeah, that sounds good. And then how's your family and how's your kids and, the whole 9 yards. I just assumed he was doing the best that could be done. He was in this huge office tower, in downtown San Francisco. How could they not know what's best for me? That's what I thought.
It was only when Mark was asked for investment advice by a friend's widow that he decided to research investing properly.
So I felt an obligation to her, number one, but I also realized that I really didn't know what was going on with my own investments. And I thought, this is a great opportunity for me to take some time to read some books, to do some research, and see how the market works. And I was literally floored, shocked, astounded, and even angry when I figured out that all of this stock selection and market timing was all a bunch of nonsense and resulted in investors earning far less than they would have if they just diversified their holdings, kept the costs low, kept the taxes low, and didn't engage in a beat the market type of attitude.
Mark then did some calculations and worked out that he would have been very much better off if his broker had advised him to invest the money he made from selling his business in a portfolio of index funds.
So had he invested in a portfolio of index funds over this 12 or 13 years, I would have ended up with $30 million more dollars. Had I known what I know now, I probably would have had far more assets than I do at the moment.
To cut a long story short, Mark founded IFA.com to help other people avoid the same thing happening to them. So, do you use actively managed funds? If so, have you really beaten the market? The chances are you haven't. And if you don't know the answer, why not get in touch with us and let us find out for you? Contact us via the details top right on the IFA website. Alternatively, click on Connect with an Advisor and enter your email, phone number and home state, and we'll get back in touch with you.